Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Friday, February 13th, 2026. Stocks finally found a floor after Thursday's AI-led hit, but don't confuse stable with strong. The tone stayed cautious. Cooler inflation pulled yields down, and that helped the S&P 500 hang in. Still, the Nasdaq just couldn't fully join in, because megacap tech and communication services kept leaning on the tape. Now look at the S&P 500 heat map. It actually read better than the headline felt. More green than red, and advancers beat decliners. But those largest tiles, the megacap tech and comm names, stayed red enough to keep a gray cloud over the index. One of those sessions where concentration matters more than participation. That heat map pattern lines up with the rotation. Money moved into defensives, utilities led the day, and real estate followed. Healthcare and staples joined the bid too. On the other side, megacap tech and communication services stayed heavy, basically a funding source. And the big tell underneath it all, small caps outperformed as traders hunted for breadth that isn't hostage to a few AI bellwethers. Here's the tension that kept this from turning into a clean rally. Disinflation was real. CPI came in at 0.2% month-over-month and 2.4% year-over-year. Rate cut hopes stayed alive, roughly a 52% chance of a first cut by June, and the 10-year sat near 4.055% late in the day. Yields clearly confirmed the macro relief, but equities didn't fully embrace it because the risk-off story is still hanging over AI-exposed software and the big consumer platforms. So the session stabilized, but leadership never really resolved. On the chatter side, a couple of narratives floated around the tape. Steel and aluminum names softened after tariff-related comments from a White House advisor. The market treated it as headline risk, not a fully priced policy shift. And heading into President's Day weekend, positioning looked cautious, with traders very aware that thin liquidity could magnify any reopening gap on Monday. None of that is a confirmed driver on its own, but it definitely shaped how people talked about risk into the close. China's AI race just went full throttle, and it's happening right in the middle of Lunar New Year. Tech giants are literally giving away cars, cash, and red envelopes in what traders are calling the Lunar New Year AI war. ByteDance is handing out 100,000 prizes to push its Dubao model. Alibaba is spending nearly $434 million to drive Qwen adoption. Demand was so intense it even caused app outages. Baidu and Tencent are throwing in hundreds of millions more. This isn't holiday marketing. It's land grab strategy. Analysts say whoever locks in users and developers now could shape long-term AI dominance. But here's the catch. Monetization is still fuzzy. User growth is exploding. Profitability isn't. Meanwhile, model releases are accelerating. ByteDance rolled out Seedance 2.0, a pro-video generator that already caught Elon Musk's attention. Zhipu AI launched GLM5 to compete on coding. Minimax rolled out M2.5, and expectations are building for next-gen releases from Alibaba and DeepSeek, the same DeepSeek that shocked global markets last year with its low-cost model. The pattern feels familiar. China's used scale and aggressive pricing to dominate industries before: steel, solar, EVs, and it's often triggered global backlash. Now AI may be next. Even Beijing is stepping in. Premier Li Qiang is pushing for faster, large-scale commercial AI deployment. A signal this isn't just corporate competition, it's strategic. Bottom line, China's AI war isn't about giveaways, it's about platform dominance. And if history rhymes, this battle won't stay domestic for long. Nvidia stayed the market's AI pulse check, and it stayed soft, down about 2.2%. Traders framed it as pre-earnings positioning, with expectations still very elevated around guidance and AI spending durability. With Nvidia as the bellwether, weakness here kept the broader AI trade feeling defensive, even as the macro backdrop calmed down. Apple was another big weight that mattered more than the average stock. Shares fell around 2.27%. Session commentary tied it to ongoing megacap de-risking, with a regulatory overhang and AI feature delays also in the mix. Even with better breadth underneath, a move like that in Apple can make the whole day feel heavier than it really was. Applied Materials was the clean upside story. The stock jumped about 8% after an earnings beat and an upbeat outlook tied to AI-driven semiconductor equipment demand. In a market that was selling megacap AI exposure, Applied looked like the classic picks and shovels trade investors were still willing to pay for. when the print is clear. Arista Networks rose about 5% on a strong print. It fit the day's bigger theme. Earnings dispersion was extreme, and single-stock reactions really drove how the session felt. In this very selective tape, the market rewarded clarity and punished uncertainty, name by name. DraftKings was the other side of that earnings coin. The stock sank about 13% after 2026 guidance disappointed, even with strong fourth-quarter growth noted in the commentary. A sharp reminder of the current rule: forward certainty is getting priced more than backward-looking beats. United Health jumped about 3.16% and helped anchor healthcare strength. With utilities leading and defensives in control, that move in UNH fit the under-the-hood message. Even as the indexes stabilized, investors still preferred steady cash flow leadership over crowded mega-cap growth risk. Looking ahead, the next test is simple. Does tech leadership come back, or do defensives stay in charge? The calendar is loaded. Tuesday brings the Empire State Manufacturing Index. Wednesday has durable goods and the FOMC meeting minutes at 2 p.m. Eastern. Thursday is jobless claims, Philly Fed, and pending home sales. Friday stacks advanced GDP, core PCE GDP prices, flash PMEs, and new home sales. With yields already lower, the focus is less about the very first rate cut and more about whether the biggest growth leaders stop acting like a drag. So the takeaway: Friday found a floor, but it was not a full risk-on reset. Breadth improved, small caps and defensives carried, and mega-cap tech still capped the upside. Going into next week, keep it simple: watch leadership, watch dispersion, and watch whether the market can turn better participation into real index momentum. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.